Hello everyone, Professor Christensen here. Today we're going to take a look at managerial accounting and what it's all about. So this is our first chapter where we actually study managerial accounting as opposed to financial accounting. And so in this chapter, there are 5 learning objectives in our chapter that we study. I'm going to focus on 3 of them in this video because, as you know, I try to keep my intro videos to around 10 minutes, and so I want to focus on the most important things and the things I think you'll find the most challenging. So the 3 objectives we're going to take a look at is, what is managerial accounting? How does it differ from financial accounting? Then we're going to take a look at classifying costs in managerial accounting, and classifying costs might seem simple, but we have a lot of different kinds of classifications, and so I'm going to spend the bulk of my time on that. And then finally, we're going to take a look at preparing financial statements for a manufacturing company, including an income statement, a balance sheet, and a schedule of cost of goods sold. All right, so let's talk for a minute about the difference between financial and managerial accounting using these 4 dimensions. So remember that the users of financial accounting are investors and creditors, right? That's the main audience for financial accounting, people outside of the company. The main users of managerial accounting, you won't be surprised to hear, are managers, which are the people inside the company. And what do they do with this information? Well, remember that for financial accounting, investors and creditors are using the information in order to make decisions about whether they want to invest in the company or loan the company money, right? And for managerial accounting, the managers in the company are making decisions that will hopefully help them to run the business better. Now, the scope of the information is also quite different. Financial accounting is very much overview, right? It summarizes everything. Think of all the transactions. Remember the accounting system, all of the transactions for the year or the accounting period are all summarized into one set of financial statements at the end of the period. In managerial accounting, the scope can be much smaller. So managerial accounting could be as small as 1 unit of product. So we're going to take a look at, for example, how much it costs to produce 1 unit of product. Now, rules and restrictions are also different because financial accounting, remember, is governed by GAAP, generally accepted accounting principles. And so you can't just put whatever you want wherever you want. Whereas managerial accounting has no such restrictions. And managerial accounting is going to vary greatly depending upon the type of company it is and also what information that they're looking for and how they need to use it. So no gap in managerial accounting. All right, so now we're going to take a look at classifying costs. And remember, there are 3 types of companies. And when you first start out in financial accounting, you look at service companies because they are the simplest. A company like, say, a landscaping company that mows lawns for a living, or a dry cleaner, something like that. Then you move on to merchandising companies, which are companies that buy and sell inventory. That's like a Target, right? They buy inventory, they sell it. And then you have to start dealing with inventory. Remember all of that and who owns the inventory and cost flows and how much the inventory costs. And now we're going to look at manufacturers, which is even a little bit more complicated because manufacturers take raw materials and they convert it into a product that's ready to sell. All right. So we're going to be looking at, in this course, we're going to be focusing on manufacturing companies. All right, so manufacturing companies have 3 different kinds of inventory instead of just 1 inventory, which is what Target would have, right, an inventory account. They have 3 different inventories. They have raw materials, which are the materials that they're putting together, that they will put together into a product when it's all done. Then they have work in process inventory, and that is items that have begun in the manufacturing process, but they have not been completed yet. And then they have finished goods, and finished goods inventory is like merchandise inventory for a merchandiser because finished goods inventory is ready to sell. All right, so remember, manufacturing companies have 3 different kinds of inventory: raw materials, work in process, and finished goods. All right, so now let's talk about direct versus indirect costs. And we'll use bicycles as an example. I grew up working in a bicycle store. Our family had a bicycle business, so I'm very familiar with bicycles. That's one of my favorite examples to use. So let's look at first direct versus indirect costs. And the cost object here, which is the place where we're trying to trace costs to, is going to be the bicycle. So a direct cost would be any cost that we can easily trace to one bicycle. What kinds of costs could we easily trace? Well, we could trace the cost of the tires, for example, the cost of the handlebars, right? The spokes, the rims. We know how much each of that cost and how much we used for each bicycle. Indirect costs would be things like the rent on the factory. So the rent on the factory is a big number, and it's very hard. You couldn't associate the rent for, say, a month with one bicycle. Right? So that would be considered an indirect cost, and indirect costs are going to require allocation. All right, let's now classify costs as direct materials, direct labor, and manufacturing overhead. So you'll see some familiar words that we just mentioned. You see direct, right? Direct materials and direct labor. So we know that those are going to be direct costs, meaning they are traceable to the final product. So again, direct materials in a bicycle, the wheels, the cost of the tires, the rims, the spokes, the handlebars, the derailleurs, all of those are direct materials. Direct labor, let's think about a handmade bicycle, which there are still some handmade bicycles. So if you had a handmade bicycle, the direct laborer might be doing something like putting decals on a bicycle or painting the bicycle. Most bicycles are not painted by hand anymore, but there might be handwork that is done on the bicycle. So a direct laborer is a person that is actually working on the bike. Manufacturing overhead is everything else, and you probably have a sense of what overhead is. Those are all the other costs to run the business, run the factory, that are not materials and labor. So manufacturing overhead costs would be things like what I mentioned before, rent on the factory. It would be depreciation on the machinery. It also includes indirect materials and indirect labor. So an indirect material is a material that we use to make the product, but that is not easily traceable. So on a bicycle, a good example would be grease, because they're going to be putting grease, say, in the hubs, and the grease that goes in there is not easily traceable, right? You don't know exactly how much you're putting in, and it's hard to put a price on that. So that would be considered indirect materials, which is part of overhead. Indirect labor is any laborer in the factory who is not working on the final product. So that would be someone like a supervisor or a maintenance person. So those indirect laborers, the cost of their labor is considered overhead. All right, so now let's look at prime costs versus conversion costs. These are just another way of classifying costs. Prime costs are just your direct materials plus your direct labor. And conversion costs are the cost to convert raw materials to a finished good. So conversion costs would be direct labor plus the overhead. Notice that both of those include the direct labor. All right, then we have product versus period. So this is important because product costs attach to the product, meaning they are inventory, they're part of inventory until the product gets sold. All right, so your product costs are, I put some abbreviations here, but I think you'll know what they are. They are direct materials, direct labor, and manufacturing overhead. Anything that has to do with the factory and manufacturing the product would be considered a product cost. And just like in a merchandiser, the product cost attaches to the inventory. It doesn't become an expense until it gets sold, and that's when it becomes part of cost of goods sold, which is an expense on the income statement. Period costs are everything else that the company spends to run its business. So selling expenses, paying the salespeople's salaries, running stores if you have stores, general and administrative expenses such as paying the salary of the CEO, rent and depreciation on the administrative buildings would all be included there. So period costs go directly to the income statement as expenses. They don't attach to the product. All right, so now let's take a quick look at the financial statements. There are other videos to help you through some of this because some of this is a little bit detailed, particularly the cost of goods manufactured schedule. So the balance sheet has, remember we said 3 inventories. So in our current assets, we have raw materials, work in process, and finished goods. So instead of 1 inventory, we have 3. Now the income statement, remember this is what you've seen before, the merchandiser income statement. And remember your cost of goods sold was beginning inventory plus the total cost of purchases, which includes freight in, minus your discounts and returns and all that. The total cost of purchases, beginning inventory plus purchases gives you cost of goods available for sale, minus the ending inventory gives you cost of goods sold. Now manufacturer looks very similar. You're going to see the things that look similar. Instead of beginning inventory, we say beginning finished goods inventory because we have to differentiate it from the other inventories. Add cost of goods manufactured. So we're not buying the goods, we're manufacturing them. So instead of purchases, you have cost of goods manufactured, and that's a calculation, which we're going to look at. And that gives you cost of goods available for sale minus your ending finished goods inventory gives you cost of goods sold. All right, so the cost of goods sold part of your income statement looks a little bit different. All right. Then you have the schedule of cost of goods manufactured, and that's how you come up with the number. So this number here is going back to our income statement here, the cost of goods manufactured. All right, so this is kind of a skeleton of a cost of goods manufactured schedule. There are some details that you would have to put in here, and you'll see those in another video and also in your book. So beginning work in process inventory, that's easy. You're going to add direct materials used. This requires a little calculation. You're going to add direct labor, and you're going to add overhead, which is a total of all of the different overhead costs that were incurred during the period. Add all those up, those 4, and you get total manufacturing costs to account for. And then you're going to subtract your ending work in process inventory, and that gives you cost of goods manufactured. And remember, that goes off to your income statement. So this is a new schedule that you have not seen before and that we're going to be preparing in this chapter. So that's all I have for you. I hope that gives you some background so you know where we're going with this chapter, and you should be all ready to study your chapter materials now. Happy studying. I'll see you in the next video.